Welcome everyone, I'm Ron Wills and you're watching the first video edition of the Inside Track, a quarterly review of news and events from around the world that impact the markets and your retirement savings. Well, as you know, Texas and other states have begun a phased startup to reboot the U.S. economy from the lockdown decreed by government officials in response to COVID-19. You'll notice the experts seem to shy away from talking about what life might look like in the aftermath of the pandemic because, in fact, they really don't know. But it sure feels like some aspects of our life may never be the same, so it seems reasonable to pause, look at the facts, and then evaluate whether the things we're still doing today make any sense. So applying this logic to retirement savings begs the question: is there even one good reason to keep funding a 401k or IRA, considering the high risk and low returns we get out of these plans? Well, today, we're going to try to answer this question once and for all. From the beginning, 401ks and IRAs were carefully crafted by lobbyists and politicians to ensure that the U.S. Treasury, brokerage houses, financial institutions, fund administrators, and others would get the lion's share of the money from these plans, not us, the investors. And because such large amounts of money are siphoned off by expenses, fees, and stock market losses, it's never been realistic to expect that a 401k or IRA could ever replace our working income, even in the good old days before the pandemic. But COVID-19 once again exposed the terrible damage caused by market losses that virtually guarantee that 401ks and IRAs will run out of money at some point during retirement. Truth be told, there is no good reason for anyone to put more money into these plans. So stay with me, listen to the facts, and then you decide whether it's finally time to give up, let go, and move on. And the best way to do that is by funding a new tax-exempt savings plan and pull the plug on the underperforming 401k right now. So the reason some people still hang on to their 401k is that conventional wisdom tells them that insurance plans cannot grow money. So how then, for the past 20 years, did our cash accumulation insurance plan, tax-exempt savings, get 6.9% compounded annual growth versus only 3.9% compounded growth for 401ks? That means our insurance plans produce nearly 80% more growth than 401ks. Is that even possible? Well, yes it is. First, tax-exempt savings never loses money due to market losses. Second, gains made each quarter are locked in, adding even more money to our plan. And third, the reset feature in tax-exempt savings produces large gains when the markets are volatile as they are now. But wait, tax-exempt savings now has uncapped indexes, which can add another 1 to 1.5% of compounded growth each year, which means future gains will now average closer to 8% a year, or about twice the gains of a 401k invested in mutual funds. So how did these two plans perform in Q1 after the pandemic hit the markets? As you can see on the chart, as the markets began to crash in February, our clients' March segment finished the year lower than it started a year earlier. And even though they did not earn an interest credit, they also did not lose any money either. However, 401k accounts ended Q1 with a 27% loss that wiped out all the gains these plans made in 2019. So 401ks invested in the S&P since 2018 have lost 3.6 a year for a combined loss of 7% as of March 31st this year. However, tax-exempt savings earned and locked in gains of 21% during the same time period, indexed to uncapped S&P low volume index. Then as the new year began in 2020, tax-exempt savings reset at the market bottom where the last year's segment ended. And since there were no market losses to make up, this segment immediately started making gains as the market recovered and is now up over 27% as of May 12th. Now we'll still have to wait until next March to see how big a fish we're going to catch, but it could be a monster gain of 30% or more if the S&P just climbs back to the February highs of this year. In the meantime, the 401k is still making up losses from the crash, but the market still has to go up another 17% higher as of May 12th just to break even. As we continue moving through the wake of the pandemic this year, the totality of its effects on the markets both here and abroad are still not clearly understood. However, I say with confidence that the unique combination of protection and growth functions in the tax-exempt savings platform were built to excel in such a time as this. No other savings strategy is equipped to earn and then keep big gains in volatile markets and produce more spendable income in retirement after tax rates go through the roof. Now, as we close out today, I want to acknowledge that much has happened since I met with some of you in person, and now would be the right time to catch up. So I'll be reaching out to set up a Zoom conference on our computers while we're still waiting for approval to resume meeting at your home, my office, or Starbucks. Thanks so much for watching today. I hope you got some information you can use. If you have any questions at all about the material we presented today, contact me and we'll talk about it. And I look forward to meeting with all of you soon.